Life insurance companies, this is a lender type that you're going to run into and that you'll be utilizing when working with our firm at Integrity Capital. Life insurance companies, you've probably, your first impression of them, and this is where you get your insurance, Allstate, Standard Life Insurance, um, some of the larger groups that you've heard of. What you didn't realize is that they actually lend money. If you think about it, they have a vested interest to be very cautious to invest the premiums that are collected. So the premiums you and I pay are then turned around and they're lent to the commercial real estate community on what would be considered long-term fixed loans. And so life insurance companies generally provide long-term fixed financing for income-producing properties. So the Trust and the Loan Companies Act and the Insurance Companies Act and the Cooperative Credit Associations Act referred to provide full commercial lending powers to federally registered trust and loan companies. So they have to have at least 25 million in capital and approval by the superintendent of financial institutions. So it's just kind of their legal element of how they're set up and structured. But it's important to understand that how they function, they typically are going to work through what they call correspondence. So most life companies you're not going to be able to go to directly. They will designate somebody for a particular geographic region, could be Arizona. They'll have one or two representatives who will service the loans, and then they are their representatives for that area. So you'll have to go through this party and negotiate with them. We have good relationships with some where you have to do a fee split. But it's worth it because you get access to really good sources of capital that can actually help you to win the deal. And so what happens is when you run into a transaction for these types of loans, you want to make sure to prepare appropriately when you go in to present to them. They have a real general way that they underwrite. So typically speaking, the lending sizes are going to range anywhere from $2 to $100+ million. The property types are going to fall under apartments, office, retail, industrial, warehouse, self-storage, etc. These are the food groups that they'll typically focus on when they're going to lend money. The loan terms are, again, term is the length that they'll go to. So 5 years where there'll be a balloon. It'll balloon at that point. 7 years, 10 years, 15 years. Sometimes they'll go even all the way out to 25. It's rare, but that can happen. Unlike a residential mortgage loan where it's 30-year fixed, you'll rarely see that in the commercial world. Amortizations are 15, 25, and even 30-year amortizations that they'll amortize the loan over. Interest rates are going to vary depending on the risk and the rate environment. You could see, depending on what's going on, 4%, 3.5%, etc. And then they have prepayment penalties that one will have to be a part of that are declining. So you could have a 5, 4, 3, 2, 1, which means it's 5% in the first year, 4% in the second, 3, etc., and onward. Or you can have what's called yield maintenance or defeasance, where it's a lot more stiff. A lot of times we call that make-whole provisions, meaning that you're going to make, they want to make as much interest as they would have if they would have kept the whole loan if you paid off early. We'll talk about yield maintenance in a later video just as to the details. Most life companies will only provide construction lending if they can do the permanent financing. It's very rare if you'll see many people doing commercial construction loans for life insurance companies, although it can happen. As I mentioned before, they work through correspondence. They are very strict on their regulations. The nice part about working with life companies is that when they issue the application to the firm, then they're typically doing so, and they're going to close the loan. They generally are not issuing applications on stuff that they don't think they can close. Typically speaking, this is a very attractive loan for a borrower. It's fixed with low rates. They're generally more competitive than banks. This is when you would utilize them. And they're easier to work with than what we would call kind of a CMBS lender, commercial mortgage-backed security loan. So they fall into a real sweet spot. Typically, when they issue the application, which sometimes, like I said, is a letter of expression of interest, then they will collect a deposit. So a good faith deposit of 1% of the loan amount is what you can expect. That is paid back to the borrower, assuming that they decline the loan. But if the borrower backs out during the time they issue the application to the time they go into committee to get an approval, then they could keep that good faith deposit, although it's rare if they do. Once they issue the commitment letter and they're approved, they will ask typically for a second 1%. In some instances, that will actually be the fee that is earned. In other instances, it's just another good faith deposit, or it could be applied towards all of the reports that they do. You're going to see reporting of an appraisal that they're going to always mandate to get. You're going to see that they're going to mandate what's called a property condition assessment report, which is an engineer who reviews to make sure that the property is in good condition. You're going to see a phase 1, making sure there's no environmental hazards. An ALTA survey, ALTA survey, make sure that the boundaries are appropriate for the title company to insure it. So those are the reports. Appraisal obviously is a given to make sure the valuation is there. They underwrite very differently and more conservative. They'll use a vacancy factor. They'll take the regular operating expenses. If there's no management fee in there, they'll underwrite with a management fee in their expense line item. They're also going to put in their reserves. So typically 15 to 10 to 15, 20 cents a foot for like a reserve or replacement reserve, etc., capital improvements. And then they'll do a TILC, so the Tenants Improvement Leasing Commission's reserve that might be another 10 or 15 cents. So they'll be a little bit more conservative on their underwriting. We'll do some underwriting models at some point. But it's important just to understand that that this is very, very successful in order for us to utilize. So that's life insurance companies for Integrity Capital